Welcome to the accounting class. In this session we shall take a further look at entries to the accounting system. Not every purchase that we make may turn out to be satisfactory, and there are occasions when it is necessary to return items. Let us suppose that a shrimp net was purchased by Bubba, which he intended to retail. The original purchase was made on credit. When the item is returned, there will be a reduction in the asset of inventory, so a credit is required for this account. There will be a decrease in the amount that Bubba owes. His liabilities are reduced. To reduce the liability account, we debit the account. Accounts payable, the liability account, is debited with $5,000. Inventory is credited with $5,000. Not everything that Bubba sells will be kept, and there will be occasions when items are returned to him and he will accept the returns. Bubba accepts the return of a canoe, the original sale being made on credit. The revenue from sales has decreased as a result of the return. To record a decrease in the revenue account, we need to debit that account. Many businesses will use a separate sales returns account to record the returns. This account will be debited. The amount that Bubba is owed has also been reduced as a result of the return. To reduce an asset account, we need to credit the account. So debit sales returns with $2,000, credit accounts receivable with $2,000. You might have also realised that if the cost of goods had been determined before the return, then a further entry will eventually adjust the inventory, since the item will be returned to inventory, assuming it can be sold again. If the customer had not made the purchase on credit, but had paid cash, then the accounts are a little different. The revenue from sales has decreased, so the revenue account will be debited to reflect the decrease in revenue. The refund will come from cash, so the asset of cash is reduced. To reduce the asset of cash, we credit the account. Credit sales returns with $200, credit cash with $200. In the last session, we looked at the repayment on principal of a loan. Unfortunately, loans usually come with a cost which is represented by interest charged on the loan. When repayments are made, a part goes to the repayment of principal and a part goes to the payment of interest. The repayment of principal reduces the liability of the loan. We need to debit a liability account to reduce the liability. The liability was recorded in a loan account, so the loan account is debited. The interest charged represents an expense to the business. To increase an expense, we need to debit the account. The asset of cash will be reduced, and to reduce an asset account, we credit the account. So there are two debits and one credit. Remember the first rule of double entry, that debits equal credits. We can see here how they are balanced. Bubba will occasionally need money which he will take from the business. He takes this as withdrawals. He will record the withdrawal, but not what he spends the money on. His personal finances must be kept separate from the business. Remember that the business is treated as a separate entity. Bubba makes a withdrawal of $300. The withdrawal has reduced equity. To reduce equity, we use an account called withdrawals and we debit the account. The asset of cash is reduced, so a credit is made to that account. Debit withdrawals with $300, credit cash with $300. Bubba has an assistant who will be paid from time to time, hopefully at regular intervals. The wage may be made up of various items, but there will be a figure for gross pay earned. This is not the amount that the employee receives, since a part is removed as taxes. The gross wage is an expense and will be recorded as a debit in the wages expense account. The amount that is paid to the employee reduces the asset of cash, and so will be recorded as a credit to the cash account. The taxes, which can be entered into several different accounts, are not paid at the same time. The liability to pay these taxes will be recorded in a liability account. To increase the liability, the account will be credited. In this case, the transaction consists of 2 credits which will add up to an amount that equals the debit made to the wages expense account. Employees come with an additional cost to the employer. Employers will be required to pay taxes for employees. These records are an additional expense and so will be recorded as debits. Since debits increase an expense account, Bubba has chosen to record this expense separately from gross pay. The taxes may not be due immediately and so they will be recorded in a liability account. Sales are not the only form of revenue that a business may receive. Bubba rents out a boathouse and receives rent as income. This rent received is recorded as a debit in the cash account. It will be recorded as a credit in the rent received account, which is a revenue account. Remember that credits increase revenue accounts. Where monies have been deposited at a bank, interest will be earned. This also represents income for the business. The debit will be to a cash account since the asset of cash is increased. The credit will be to an interest received account, which is a revenue account. In order to prepare financial statements, one step that has to be taken is to determine the cost of goods sold. This is done by determining the amount of inventory that has been sold and using that figure as the expense of cost of goods sold. Since cost of goods sold is an expense, then to increase the account, a debit is required. The inventory has been reduced. Inventory is an asset, and to reduce an asset, we credit the account. If inventory has been reduced by $4,500, then the expense of cost of goods sold will have increased by $4,500. This is the end of this session on double entry. Thank you for watching and for listening.